Just think about in January what you were thinking and hearing from all the people you speak of. It was just first going to 4,600. Man, everybody was excited, telling you all the reasons this is gonna go so higher. Now it came back to 4,600, actually went lower than that. Oh my God, it's the end of the bull market. We're never gonna see
Oh,
gold up again and all.
yeah.
You've been
Yeah.
around this long enough to know, Daniela, that this was really a much needed, healthy corrective phase, mini bear market, what everybody wants to call it all.
Keep in mind that gold, unlike dollars, can't be printed at will. There's still the same stock to flow ratios. They remain the same. And so supply is tightening, and this tightening of supply is about to collide with a renewed demand for gold. So what will send gold demand higher is a key question we have to think about. And the answer to that is really hard to believe. It's a falling dollar. But how can the dollar be falling when it's in such demand in times of war?
Gold and silver stand at a pivotal crossroads, where volatility masks a deeper structural strength that could define the next phase of the bull cycle. After a dramatic surge followed by a sharp correction, the precious metals complex is now entering what seasoned analysts describe as a more disciplined and sustainable advance, one that may ultimately prove more powerful than the earlier parabolic rise. According to Peter Grandich of Peter Grandich and Company, the emotional extremes witnessed earlier in the year reflect a classic cycle of market psychology. In January, widespread optimism drove expectations that gold would surge relentlessly beyond the 4,600 level. However, when prices retraced sharply, briefly breaking below 4,000, sentiment flipped almost instantly pessimism, with many declaring the end of the bull market. Grandich interprets this not as structural weakness, but as a necessary corrective phase that removed speculative excess. From a long-term perspective, he views the pullback as extremely bullish, emphasizing that no sustainable bull market advances in a straight line. Grandich further notes that gold's explosive performance in 2025 set unrealistic expectations. Triple-digit annual gains are neither typical nor healthy for long-term price discovery. When markets enter parabolic territory, he argues, experienced participants look to reduce exposure rather than chase momentum. His own strategy reflected this approach. He exited positions during the surge and re-entered selectively after the correction, focusing more on mining equities such as GDX and GDXJ rather than physical gold. In his view, the next phase of the cycle will likely reward equity exposure more than the metal itself, offering greater percentage returns through operational leverage. If you're finding this analysis helpful, take a moment to like this video, subscribe to the channel, and hit the bell icon so you never miss timely updates on gold, silver, and precious metals market.
One of the things that people lost sight of in the height of the parabolic rise in January in gold was how extraordinary the gain was in 2025. We should not expect, nor, in a sense, wanting, if you want higher prices, for gold to go up triple digit every year. And it just got ahead of itself. I think that's the simplest explanation to put in. When anything goes into this on a chart, no matter what it is, I'm looking to get out, not in. And so when it happened, I said, well, look, the corrective phase could be down to 4,400. Well, it went through 4,400 like Grant went through Richmond all in a couple hours, and suddenly we were barely holding on to 4,000. But on that March 23rd day, I had thought that all the excess has been taken out. The opportunity to get into some very attractive plays besides the metal themselves was presenting itself. And I jumped back in more narrower in when I was the last time, as much capital as before, but more focused on more selectivity. One, for the majors, I decided to go with the GDX and GDXJ because they gave me kind of coverage on a lot of them. And then I had these selected issues that I own and all. I like to tell you that some special technical formula or this fundamental process I've had for years, but it was really a gut call. I mean, that's really what it came down to. Well, on the physical exposure, the answer was yes. I liquidated
Wow.
all that exposure. And not to take anything away, I'm still in the camp that I was a year ago, that it's gonna end up much higher than even it got in January. The thing that's more challenging now is that I think it's gonna be more of a subtle and more, steady and slow rise, And I think the profitability and the leverage will come more from the share side than it did in the physical. Now, I'm not in the camp that I'm going to want to own gold because some days things are going to be so bad my life could survive on it. I just never been that way. I own it for, can I make money on it? And if I can't, I don't own it. I think the shares will percentage wise be more of a return, and that's why this on this leg, I'm in it. But there are people and are reasons to own physical gold, and for those people, this opportunity of the pullback here was an opportunity to get on board. If you think
Yep.
about this, just think about in January what you were thinking and hearing from all the people you speak of. It was just first going to 4,600. Man, everybody was excited, telling you all the reasons this is going to go so higher. Now it came back to 4,600, actually went lower than that. Oh my God, it's the end of the bull market. We're never going to see
Oh,
gold up again and all.
yeah.
You've been
Yeah.
around this long enough to know, Daniela, that this was really a much needed, healthy, corrective phase, mini bear market, what everybody wants to call it and all. It was extremely bullish if you still are long-term bullish. Yeah, I think it does, and I think the Fed is kinda caught here, as you again, as I speak. We had numbers out today from Jolt
Yeah.
that basically said there's no growth in employment, and basically, we're not losing a lot of jobs because no one wants to leave their jobs. They're
Yes.
trying to hang on. But here's the story that I think that we'll talk more about if fortunate enough to be blessed to be here in the next 1 or 2 years. I don't think people have come to concluding how much AI is gonna impact the employment picture on a negative standpoint. I think that's a topic 6 to 12 months from now. The financial world will be talking a lot more, not about all the stocks in 25 that were going up and people making money, but how much AI has gotten to the point where it's actually causing serious drop in employment. And I think that's a topic to come here in the United States and abroad.
Meanwhile, Matthew Piepenburg, partner at Vaughan Grayers, provides a broader macroeconomic lens. He highlights the enduring importance of gold stock-to-flow dynamics, noting that unlike fiat currencies, gold supply cannot be expanded at will. This inherent scarcity is becoming increasingly relevant as global demand dynamics shift. Piepenburg argues that a tightening supply environment is on a collision course with rising demand, potentially driven by a weakening US dollar over the longer term. However, he also points out that short-term market behavior can appear contradictory. Geopolitical tensions, particularly those influencing oil prices, often lead to inflationary pressures. These, in turn, can strengthen the dollar due to expectations of higher interest rates, temporarily weighing on gold prices. Yet beneath this surface dynamic lies a more complex reality. Nations facing rising energy costs and limited dollar liquidity are increasingly forced to liquidate gold reserves to meet immediate needs. Recent developments illustrate this trend. Countries like Turkey have reportedly sold significant quantities of gold to secure dollars for energy imports, while Gulf nations face their own liquidity pressures amid disrupted oil revenues and rising geopolitical risks. These forced sales create temporary downward pressure on gold prices but do not reflect a weakening of the underlying thesis. Instead, they underscore gold's role as a last resort liquid asset in times of financial stress. Let's get back to the video.
Okay, so what's happening with gold today? It's April 1st, 2026. Now, in prior videos, my colleagues and myself have addressed the traditional and not so traditional narratives, including the very important issue that war-related oil shocks have an impact on gold, but not always as you think. An oil shock creates inflation, of course, and with inflation, the markets predict or price predict higher rates and a stronger dollar, because rates make the dollar go up. And when the dollar goes up, gold can certainly go temporarily down, but not for very long. But there are other forces connected in part to this oil shock that are not so easily understood by most, as most are not getting really the broader picture, which involves a forced sale of gold by nations who don't want to sell their gold at all, but are forced to because of a war that the vast majority of the world doesn't seem to really want. But again, and as always, I'll stay out of the politics and just stick to the economics, and therefore the data, which we can all agree upon objectively. And toward this end, we must address the reality that major nations and central banks, after many years of stacking gold to move away from US treasuries and the weaponized, unloved US dollar, are now becoming forced sellers of their gold. And the reasons for this are directly tied to the black swan and the black smoke of this latest war. Now let's start with Turkey. What it just did. In Zurich, where we work out of, it just swapped 60 tons of gold in the last 2 weeks. That's more than 10% of Turkey's gold. Other nations and central banks from Poland and elsewhere have done the same. But what Turkey just sold was larger than all the ETF gold sales since the war began. That was 43 tons. So why did Turkey have to do this? Well, the simple answer is it needed dollars to buy oil. 90% of its oil and gas is imported. It must be paid for in petrodollars. That means US dollar oil. But oil has gone from 70 to 90 to 100 to 115 and beyond in a matter of weeks. And each $10 oil hike in price cost nations like Turkey an extra $5 billion. So they need the money. And they don't have any good options. What other options do they have? Turkey could kill its lira, print more lira to buy more dollars. But they've already suffered enough inflation based on the inflationary export in US dollars since the 70s. They could also empty their US dollar reserves or their piggy bank, but that's very dangerous as well. So what do they do in the near term? As always, they sell the good in a bad situation. They sell the most valuable and liquid asset they can to get dollars to buy oil. Because oil, regardless of your green energy ideology or thoughts or debates, we still live very far from a carbon neutral world, and energy and oil still drive everything. Now, meanwhile, in addition to Turkey, we have the Gulf states. The oil states are selling gold too at massive levels. But they certainly have the oil. They're not like Turkey. They've got the oil. So why are they selling gold? The reasons are entirely different from Turkey, but sadly the causes, namely war, are exactly the same. Now, the Gulf states like Saudi Arabia, Qatar, Oman, Kuwait are in their own kind of trap. In fact, in many ways, it's a much worse trap than Turkey finds itself in. In times of peace, oil sales keep their dollar flows pouring in the GCC and the Gulf states and the OPEC nations. But with the Strait of Hormuz closed, those flows are stopping, which means the income to these oil nations is stopping at the very time their costs are rising. Now think about it. Saudi Arabia imports 80% of its food, and those food bills still need to be paid. And their military costs are also rising, so they need more dollars. But they're not getting those dollars from the oil flows right now with this war. In addition, a lot of expats, wealthy expats with a lot of dollars, are leaving these sinking ships where residue is falling from the skies from missiles and bombs. They're leaving the Gulf states, they're leaving the oil nations, and they're taking their dollars with them. That puts more pressure on these Gulf nations to come up with more dollars to fill their reserves.
At the same time, structural shifts in the global economy, such as the growing impact of artificial intelligence on employment, are beginning to emerge as potential long-term drivers of uncertainty. Despite recent volatility, both analysts converge on a common theme: the long-term trajectory for gold remains upward. However, the path forward is expected to be less explosive and more measured. This transition from a speculative surge to a steady climb may ultimately provide a more durable foundation for higher prices. Silver, often more volatile than gold, is likely to follow a similar pattern but with amplified movements. As industrial demand intersects with monetary demand, its performance could outpace gold in percentage terms during the next leg higher. Yet, like gold, it will remain sensitive to macroeconomic shifts and investor sentiment. In this evolving landscape, the distinction between short-term noise and long-term fundamentals becomes increasingly important. Corrections, while unsettling, may serve as opportunities rather than warnings. The interplay between currency dynamics, geopolitical stress, and structural economic changes will continue to shape the metals market in the months ahead. As the market stabilizes after its recent turbulence, a critical question emerges. Will the next major catalyst for gold's ascent come from currency weakness, geopolitical escalation, or an unforeseen economic shock? If you found this breakdown helpful, don't forget to like, subscribe, and share it with others following the gold market. Thanks for watching. Stay informed, stay balanced, and I'll see you in the next video.